You understand that options trading can be a powerful tool for generating income and managing risk, and you're ready to learn the right way. The truth is, professional traders follow a structured approach to options trading, and I'm going to teach you the skills to master it. I used to be a professional derivatives trader at a major investment bank for many years. And in this series, the complete beginner's guide to trading options, I'm going to share the playbook I used to navigate the markets. I know you're eager to get to the advanced strategies, and we will get there. But the journey to becoming a truly successful trader starts with a rock-solid understanding of the fundamentals. This video and the next few are all about mastering the basics, the essential building blocks that will allow you to unlock the full potential of options. Trust me, it's the most important step you can take to prepare for success. We're starting with the most fundamental question of all. What are options? And what are the two types, puts and calls? If you're new to trading, the world of options can feel like another language. You hear terms like strike price, premium, and expiration date, and it's easy to get lost. But at their core, options are not all that complicated. An option is simply a financial contract that gives you the right, but not the obligation, to buy or sell an asset at a specific price. This right, not the obligation part, is crucial, and it's what makes options so powerful and so different from simply buying a stock. But when can you exercise this right? For European options, this right can only be exercised on the expiration date itself. For American options, which we will be using in all our examples, this right can be exercised anytime up to and including the expiration date. Put it in a real-world context, think about a real estate option. Let's say you find a house you love and you want the right to buy it for $500,000 sometime in the next 3 months. You could pay the seller a small fee, say $5,000, for that exclusive right. In this scenario, you've bought a real estate option. You have the right to buy the house at $500,000, but you're not obligated to. If the housing market goes up and the house is now worth $600,000, you can exercise your option, buy the house for $500,000 and immediately have a profit. If the housing market crashes and the house is only worth $400,000, you simply walk away. You let the option expire and your only loss is the $5,000 you paid for the right. An options contract works on the exact same principle, just with financial assets, like stocks, ETFs, or even indices. In this video, we'll focus on the perspective of the buyer. We'll save the topic of selling options, which has a much different risk profile, for a later video in the series. Now, let's look at the two main types of options, calls and puts. We'll start with call options. A call option gives the buyer the right to buy an asset at a predetermined price, which we call the strike price. You would consider buying a call option when you believe the stock's price is going to go up, and you want to make money from that upward move. Let's use a clear example. Imagine a company called Innovate Corp, ticker INV, is trading at $100 per share. You've done your research and you believe this stock is going to rally. Instead of buying one share for $100, you decide to buy a call option. You purchase a call option that gives you the right to buy one share of INV at a strike price of $105, which expires in 30 days. And let's say you pay a premium of $3 for the option. Here are the two possible outcomes and how you make money. Scenario A, the stock price goes up. Before the expiration date, a major news announcement sends Innovate Corp's stock price soaring to $120. Your call option is now valuable. You can exercise your right to buy the share at the $105 strike price and immediately sell it on the open market for $120, making a profit of $15 for the option. After subtracting your initial premium of $3, your net profit is $12. This example illustrates how options can provide leverage, allowing for a meaningful return on a relatively small premium. Now scenario B, the stock price stays below the strike price. The stock either goes down or only rises to $104. Since the stock is trading below your 105 strike price, the option is worthless at expiration. You've simply let the option expire. The maximum loss is limited to the $3 premium you paid. This shows how options give you a chance for a significant return with a known limited risk. Now, next we have put options. Put option gives the buyer the right to sell an asset at a predetermined strike price. You would buy a put option if you believe the stock's price is going to fall and you want to make money from that price drop. Let's use another example. Imagine a company called Stable Industries, ticker STB, is trading at $50 per share. You've done your research and you believe the stock is due for a downturn. You could buy a put option with a strike price of $45, expiring in 60 days. And let's say it costs you $2 for the option. Here are the two possible outcomes and how you make money. Scenario A, the stock price drops, a recession hits and Stable Industries stock price plummets to $35. Your put option is now in the money. You can exercise your right to sell the share at a $45 strike price, even though it's only worth $35 on the open market. This gives you a profit of $10 for the option, and after subtracting your initial premium of $2, your net profit is $8. Scenario B, the stock price goes up or stays above the strike price. The market stays strong and Stable Industries stock rises to $60. Your put option is now worthless. You simply let it expire and your only cost is the $2 premium you paid. In this case, your maximum loss was limited to the premium. So, to quickly recap, an option is a financial contract giving you the right but not the obligation to buy or sell. Call options are for when you think a price will go up. Put options are for when you think a price will go down or to protect against a downturn. This is just the very beginning of our journey. In our next video, we'll dive deeper into the concept of the option premium, the price of the contract itself, and how crucial factors like time and volatility affect it. Understanding this is a key step toward making money from options. If you found this video helpful, please hit that like button. Make sure you're subscribed so you don't miss the next one. Thank you for watching.